Good afternoon. Good afternoon, ladies and gentlemen, and welcome to your university, Montana State. My name is Wadet Cruzado, and it is my honor to serve as president of this great institution. It is also my honor to welcome all of you to the Federal Reserve Town Hall at Montana State. I would particularly like to welcome all of the members of the Montana banking community who are in the audience today. Would the members of the Montana banking community who are with us today please stand up so that we can recognize you for the important work you do for each one of us. As you know, today's event was organized with the help of Montana State University's Community Banking Program, which is an innovative partnership between MSU and the Montana banking community. Montana Independent Bankers, the Montana Bankers Association, and First Security Bank provided the startup funding for this wonderful program, along with many other banks across Montana. And between these entities, almost every bank in Montana is represented in the program. We're very proud of that. Although this program is relatively new, we have already placed 17 interns in Montana banks, along with a similar number of permanent employees. If you are a student here today who is interested in a career in banking, or if you are a banker interested in finding trained and experienced young professionals for your business, please contact us at the program. You may do so by simply searching Community Banking Program from MSU's homepage. I would also like to welcome all our faculty and students and staff, and a special greeting to our Jake Jabs College of Business and Entrepreneurship. Our dean, Mark Rinaldi, is with us here this afternoon, and many of the faculty members and staff. With the faculty members of the Jake Jabs College of Business and Entrepreneurship, would you please stand up and be recognized? I would also like to acknowledge our very own Dr. Marcia Getting, who has been on the Helena Board of Directors for the Federal Reserve Bank of Minneapolis since 2012. As an MSU Extension Family Economics Specialist, Dr. Getting works tirelessly, traveling throughout Montana, presenting workshops on financial and estate planning topics. To date, Dr. Getting has held over 1,500 workshops, reaching almost 46,000 Montanans. Marcia, I saw you earlier. Would you please stand up and be recognized? And once again, to all of you, welcome. Now to our guests. Neel Kashkari took office as President and Chief Executive Officer of the Reserve Bank of Minneapolis in January 1st, 2016. During his brief tenure, he has made it a priority each year to visit local communities in every state in the Minneapolis Fed's 9th district, which includes Minnesota, Montana, North Dakota, South Dakota, and portions of Wisconsin and Michigan's Upper Peninsula. The Minneapolis Fed also has a branch office in Helena, as I mentioned before. Additionally, President Kashkari is a member of the Federal Open Market Committee, the body of the Federal Reserve System that sets national monetary policy, including interest rates, which makes today's lecture particularly vital and interesting to all of us. While Mr. Kashkari is visiting the Bozeman region, he will also meet privately with business and community leaders, many of whom are right here in this room. Our moderator this afternoon is Larry Simpkins, President and CEO and Director of the Washington Companies based in Missoula, and a former board member of the Minneapolis Fed. It also happens that I consider Larry my good friend. Without any further ado, please join me in welcoming back to Montana State University Neel Kashkari and Larry Simpkins.
Well, thank you. Before Neil gets started, I think there's a couple things that we need to talk about. You know you're in Montana when you're in cowhide chairs, so welcome to Montana. It is really an honor for me to be here with Neil. I was fortunate to get to know Neil in 2016 in my final year on the Federal Reserve Board, and you're in for a real treat this afternoon. I would really encourage you to ask questions because there's a lot that Neil has to offer, and he's sincere in knowing what you want to hear. But before we get started, I want to tell you a little bit about Neil. And interestingly enough, Montana State University is a perfect place for Neil to be. So what was your original degree in, Neil?
Mechanical engineering.
So Neil's a mechanical engineer. So for you engineering students out there, by the end of this, I think we're going to want to find out how a mechanical engineer becomes the president of the Federal Reserve Bank of Minneapolis. So it's an interesting jury, but it's probably safe to say that had President Cruzado been at Montana State when you were making that decision, you might have come here.
Absolutely, absolutely.
So Neil, why don't you just start by telling us a little bit about the Federal Reserve and what you're doing and the purpose of a trip like this.
Well, thank you, Larry, and thank you, Madam President, and all of you for hosting me today. So there are 12 Federal Reserve banks in the country. And if you go back in American history, our nation has always been concerned about having a central bank. We didn't like the idea of it. Alexander Hamilton actually created the idea for the first central bank, first bank in the United States, with President Washington's support. It lasted about 20 years, and then they got rid of it. Because it just sounds undemocratic, a bunch of bankers in a dark room doing God knows what. They didn't like it, they got rid of it. Then they created a second bank in the United States, and then President Jackson got rid of it. Then our economy, especially the ag economy, was hammered with financial crises in the late 1800s, and a big one, the banking panic of 1907. And then Congress said, well, even though we hate the idea of having a central bank, I guess we need to have one to manage these ups and downs in the economy. But if we're going to have one, we don't want it all concentrated in Washington, D.C., because that just doesn't sound very democratic. So let's distribute it around the country. So Congress in 1913 created the Board of Governors in Washington, D.C., and 12 independent regional Federal Reserve banks, the 9th of which is the Federal Reserve Bank of Minneapolis. So our jobs at the Minneapolis Fed are literally to represent all of you. So a big part of my job and my colleagues' jobs are to travel around our region to understand what's happening in the local economy and the regional economy and bring this back to Washington, D.C. So I go to Washington, D.C. 8 times a year for what we call Federal Open Market Committee, or FOMC meetings, where we debate the national economy and we set interest rates for the nation. And my job is in part to speak about what's happening out here. So the reason I spend as much time as I do traveling around our region is I want to hear directly from citizens, from community members, from local business leaders and local bankers, what's happening in the local economy, how's it going, what's happening in the job market, what's happening to wages. That information then makes us smarter about where we are in our economic cycle, and I can bring it back to Washington, D.C. So as Larry said, please be candid with your questions or your comments to me. The more direct you are, and I'm not going to get offended, the more direct you are, the more I'm going to learn from you. And so I really look forward to having an active Q&A, and thank you all for turning out. This is a great turnout, and I really appreciate it.
So we have a couple of mics around the room. If you'd raise your hand, if you have a question, they'll bring the mics to you and we'll have the questions for Neil. And as we're doing that, before we get started, I have a couple questions for Neil just to get us started. Neil was responsible during the last financial crisis for the Troubled Asset Relief Program known as TARP. And so he is an outstanding expert and spokesman for the last financial crisis. And I think
I'm not sure that that's a great thing to be proud of, but go ahead.
He's been a critic of too big to fail. And that's one of the topics that I think is coming back up again. And Neil, if you would address that a little bit on too big to fail and kind of where we're at 10 years post the crisis and Dodd-Frank and the things associated with that.
Sure. So 10 years ago, we had almost, to the day, to the week, the major financial crisis that brought the U.S. economy on the brink of collapse. And at the center of that crisis, we had the housing boom through most of the 2000s, and then we had the housing bust. And you had these giant banks in the center of our economy which had all of these mortgages on their books that they thought were good, that ended up not being good, and those banks were on the verge of failing. And it was up to the taxpayers, all of you, through the Treasury, where I worked, and the Federal Reserve, to intervene to prevent those banks from collapsing. Now, we hated that we had to do that. The idea of using taxpayer money to bail out banks is awful. But the alternative was the U.S. economy would collapse under what was basically a massive heart attack. So we never, ever want to have to do that again. So we at the Minneapolis Fed have done a lot of work studying this problem of these big, giant banks in the heart of our economy and asking the question, are they still at risk? Could they still fail? Could they still require taxpayer bailouts? And unfortunately, the answer is yes. They are safer than they were 10 years ago. They have more skin in the game, but they're not safe enough. And we think that we can do a lot better than that. Now, it's not politically popular. Right now, the winds are blowing in a deregulatory direction when we need to actually do more on the biggest banks. But we need to keep getting the message out and letting the American people know that there are still these risks and we can do something about it. Let me just give you one little analogy. When my wife and I moved to Minnesota, we bought a house, and the bank made us put 20% down on our home. The reason that you have to put 20% down on your home, that 20% down payment is there to protect the bank in case you run into trouble. So if you lose your job and the bank has to repossess your house, they've got that 20% cushion to get their money back. Well, big banks don't have 20% down on their own investments. They have about half as much. So it's not that complicated. If we made the biggest banks in America, there's about a dozen of them, put down 20% on their own investments, we could basically solve the too big to fail problem because it'd be their own skin in the game. So that if they ran into trouble, they would take the losses rather than taxpayers. And so we have a lot of work yet to do, but that's the nut of the problem.
So let's talk about today a little bit about, I mean, you've been widely criticized and heralded for not raising interest rates too fast, cautioning about that. So talk about raising interest rates and the economy and kind of where your thoughts are right now on that.
So the way the Federal Reserve, what we're basically doing on a day-to-day basis is we're trying to manage the ups and downs of economic cycles. So if it looks like the economy is slowing down and we're heading into recession, typically the Federal Reserve will cut interest rates, which makes it cheaper for you to get a home loan or for a business to get a business loan to go and invest and say open a factory, and then that stimulates economic activity. If it looks like the economy is overheating, the Federal Reserve will typically raise rates to have the opposite effect, make it more expensive to invest, more expensive to buy a home, and cool things down so that we don't overheat. So one way we measure is the economy overheating or not is we typically look at the unemployment rate. If a lot of Americans are unemployed, that usually means there's a lot of slack in the economy and the economy has room to run. Well, in the last 10 years, that unemployment rate has fallen from 10% in 2009 to about 3.9% today. Typically, that would be an indicator that we're at full employment. Everybody who wants to work is able to find a job. But the thing that's complicated about this is that number, the unemployment rate, 3.9%, it only includes people who are actively looking for work. If you lost your job in 2010, let's say because you got laid off, and then you couldn't find a job, a lot of people gave up, and they left the job market altogether. So they're not counted in that 3.9% number. So a big factor that we're all looking at is, are we really at maximum employment? Everybody who wants to find a job, are they able to find jobs? One indicator that we're not there yet is that wage growth has been quite low. And while businesses say they can't find workers, we're not seeing booming wages in the national economy. That tells me there may still be some more labor market slack. So this is the debate that we've been having at the Federal Reserve. Are we at full employment or maximum employment? Is there still room to run? Is the economy overheating? I've been saying, no, we're not there yet. And I feel like so far, the fact that inflation has been very low and wage growth has been muted is evidence that we're not there yet. But this is the debate that we're having, and that's why I've been objecting to the interest rate increases that we've been pursuing.
And with the dual mandate, is there more emphasis on unemployment or inflation? How do you view that now?
So Larry mentioned the dual mandate. What that is Congress has given us, so Congress created the Federal Reserve, and they gave us two primary goals. One is stable prices. So think of an economy that's not overheating and then not too slow, kind of just right. And then maximum employment, as many Americans are able to find jobs who want to work. Typically, these two goals price stability and employment are linked through wages. So in Bozeman, I had a meeting with a bunch of tech companies this morning, and they love to say, well, we can't find workers, it's so competitive. Well, when businesses can't find workers, they tend to poach them from each other, and they tend to pay more to attract you to jump over to another. So as businesses are competing with each other to pay more, wages start to go up. But then as wages go up, businesses have to then pass those costs onto their customers, and that leads to more inflation. So typically you think about price stability and employment as linked through wages. So that's what we're wrestling with. It's hard to say one's more important than the other. They're both important to us. But right now, there's not been a trade-off because inflation has been at our 2% target or low, and wage growth has been low, and the job market keeps getting stronger so that we have not had to make a trade-off yet.
Okay, question?
I know you were just talking about how unemployment is fairly low as well as inflation, and that's kind of getting, some may argue, like you said, that it is starting to overheat or get closer. We know the housing industry was last hit hardest by the recession. Which industry or sector do you see as the most vulnerable for a recession coming up in the future?
Boy, that's a really good question. It really depends on where the shock is going to come from. So we know that economies don't grow forever. Something comes along and knocks them off. And so what are some of the risks to the global economy? One risk to the global economy is the trade skirmishes that we're having, the United States and other countries. And we have a lot of export-sensitive industries. Ag is a very export-sensitive industry. Our natural resources, very export-sensitive. Manufacturing, very export-sensitive. So if I described trade battles a little bit like a game of chicken, you know, you want the other side to blink, but once in a while you crash into each other, which is what you really want to avoid. So if we actually have a full-fledged trade war, I would imagine our export-sensitive industries like ag, like commodities, like manufacturing would probably be the most directly hit. You could also see another risk to the economy coming from the emerging markets. You know, there are other countries like Turkey and others having political challenges, economic challenges. Those could lead to some type of contagion around the world potentially. And then maybe if we have companies exporting to emerging markets, they could be directly affected by that. And then of course it could be the Federal Reserve. If we just increase interest rates too much beyond what the economy can sustain, we could end up ending the expansion. And then you would see capital-intensive industries that are really dependent on borrowing, such as housing, as an example, or commercial real estate. I would expect those industries to get affected. So it's hard to answer your question because we don't know where the spark is going to come from, and different scenarios will affect different industries differently.
Hello.
Hi.
That's on?
Yep.
Okay. Well, I've always wondered about national deficits. I've had a hard time understanding them, but I was going to ask you this question. What is the greatest threat or concern posed by a very large national deficit?
Long term, the greatest concern is basically national deficits mean that we're spending more than we are producing right now. So we're borrowing money and spending it. And eventually, you can't do that forever because your debt, either you as an individual or as a family or as a city or as a country, eventually the debt crowds out. You have to service the debt. You got to pay your interest payments, and it crowds out your other priorities. So let's say if our debt keeps expanding, eventually you would expect to see inflation climb and interest rates climb, and then we'd have less money to spend on education or healthcare or defense or infrastructure. And so typically what ends up happening is interest rates rise, inflation rises, and there's a big crowding out of other priorities. Now the question is, when is that going to happen? Right now we have a lot of debt to GDP, around 100% of debt to GDP ballpark, which is quite high relative to American history. At the same time, borrowing costs for the US government are very low. So the 10-year treasury rate right now is around 2.85% ballpark. That's quite low historically, which says that right now global investors are not that concerned about the debt, but we also know this can't go on forever. So at some point we have to make tough choices and live within our means, but we don't know exactly when that day of reckoning is going to come, unfortunately.
Why don't you expand on that just a little
Sure.
bit and talk about the difference between monetary policy and fiscal policy?
Sure. I mean, absolutely. So fiscal policy, this is the domain of Congress and the state legislatures, and this is simply how much they choose to tax you and me, and then what those tax revenues are spent on. be it education or healthcare or defense or infrastructure. Monetary policy is the Fed's domain, which is considered to be separate, and we just set the amount of dollars in the economy to try to manage these ups and downs of the economic cycle. So again, if economic activity is slowing down, we'll put more dollars in the economy effectively by cutting interest rates to make it cheaper for businesses to buy things and invest. And then if it looks like the economy is overheating, we'll bring dollars out of the economy. So we're not deciding how much to tax or what to spend it on. We're just trying to manage the ups and downs of those economic cycles by setting interest rates.
Okay.
Yeah, you did mention the federal fiscal situation kindly, I would say. As you look at interest rates, as you indicated, they're low right now. But every quarter point with our debt right now, it adds about $40 billion by my calculation to interest costs. And interest cost is the fastest rising item in the federal budget. So how are you going to get out of the pickle of a rising debt, the low interest rates, without making interest costs from $3 billion to more like $1 trillion or $700 billion?
So I will say, not really tongue-in-cheek, but kind of bluntly, that's not our problem. Meaning the Federal Reserve's job that Congress has given us is to achieve our dual mandate goals: stable prices and maximum employment, and adjust interest rates objectively independent of politics to try to achieve those two outcomes. It's up to Congress and the executive branch to decide how much to tax us and what to spend on and how to finance the government spending. So, I mean, I don't mean to be a smart aleck when I say that, but literally, our job is not to think about how does Treasury finance itself. That's Treasury's business. Our job is simply to achieve the dual mandate goals using the tools that we have available over an economic cycle. But you're right to raise it. It's a legitimate concern, but that's for your and my elected representatives to try to address. It's not the Federal Reserve's job to address that problem.
Hey, I'm a finance professor from Jake's College. I'm doing some research on corporate debt, so I'm really seeking your opinion on this. I find recently that the corporate debt issuance activity has been dramatically decreased, and that the underpricing of corporate bonds has decreased also. So I was trying to understand whether it's is from the supply side because the firms think that the cost of debt is increasing, or from the demand side that the institutional investors' demand for corporate debts is decreased, or it's just because some policy change, structural change?
So I guess I'm surprised by the premise of your question, and I'm not saying you're wrong. I haven't looked at the data lately myself, but typically I think that corporate spreads are quite low. So if Treasury borrowing costs are low, and corporate spreads on top of those low borrowing costs are also quite low, I would think it's an attractive time for a issuer to go issue debt at very attractive rates. Now, it may be that they're turning to other lending sources rather than the corporate bond market, but I don't know. I would need to look into it. I don't know, Larry, what you're seeing in your business. I would think that terms are very attractive right now if you wanted to go raise debt.
Yeah, terms are attractive, but also there's lots of assets are fairly high priced. There's lots of people looking for assets. And so I think part of that answer might be that the appetite for private equity, for instance, in some of these areas is providing equity, whereas in the past it might have been debt finance with some other things.
I see. Thank you. Somebody back there I thought had a...
Hi. So I had maybe a little bit of a vague question, but like Megan said, a lot of us are looking for weaknesses in the economy. How does the Federal Reserve feel about the student loan market and increasing debts being taken on there?
Well, it's a huge long-term challenge. You know, we know over time this has always been true, and it's only increasingly true. Education is more and more and more and more important, and it's only going to become more important. So we as a country have to find a way of educating more and more of our young people with more education and higher quality education. And the answer cannot be just saddle students with more and more debt, right? If you demand more of something, the price goes up. So demand for education is only going to continue going up, but we need to find a way to fulfill that demand and drive prices lower. And so this is a big fundamental challenge that we have to tackle as a country. It may be different delivery models. It may be that, four-year college is great for a lot of students. Not every student has to go to four-year college, and maybe there are other two-year programs, et cetera, which may be very good alternatives for some students. I think we need to look at all of the above, but we know it's not sustainable to simply say, hey, every student and your kids just take on more and more and more debt. It just doesn't work.
So the methods of determining inflation through the CPI have been called into question recently.
By whom?
By
People on Twitter?
many people looking into the validity of the statistics used on housing and rates there for the CPI. If that influences the inflation, are you guys looking into it, or are you not considering that at all with your inflation statistics?
We look at a lot of different statistics to try to get a sense of inflation, not just where inflation is now, but where inflation is going. So our preferred measure is called, it's actually PCE, Personal Consumption Expenditures, which is similar to CPI, the Consumer Price Index, but it's a little bit different, and there's about a 0.3 adjustment between the two typically. So we look at a lot of different measures to try to get a sense of what's actually happening to inflation. And by most measures, it has been running below our 2% target. Now it seems to be right at our 2% target. We also strip out energy and food, which tend to be very volatile, even though there is some bleed through in the underlying core inflation. So, the Federal Reserve has more PhD economists in the country than anybody in the world. I mean, we've got a lot of them, and a lot of folks dive into this data in great, great depth, trying to get a sense of where is inflation today, where is it going. And I agree, the measures are not perfect, but don't believe the stuff you see on Twitter, that it's a big conspiracy and all the numbers are being rigged. They're not. If anything is an unreliable source of information, it's Twitter. And as a Twitter participant, I can verify that. But yeah, so the measures are not perfect, but I think overall they're pretty good, and they're always getting better. And economists are always looking at them to try to find ways of improving them, and we make our own adjustments to try to improve them as well.
In that vein, just let me make a quick comment that, when Neil joined the Federal Reserve in 2016, if you were to look prior to that and go even a decade back, there was not much information on the Federal Reserve. To have an open forum like this and have Neil participate in it and answer questions openly is something that was just unheard of in the Federal Reserve. And Neil has really been a leader in the entire system. He was the first president to be on Twitter. And if you're not following him, I encourage you to. But open communication with the Fed, Neil, I applaud him for being a leader in the entire system, for reaching out to everybody in this audience and communities to get real ground level information to make the decisions that they're making. So,
well, the history of that is, thank you. The history of that is the Federal Reserve was a little bit like the Wizard of Oz, which was, don't ask any questions. We won't tell you anything, just leave us alone, we'll do our thing, you do your thing. And then the financial crisis hit, and the Federal Reserve had to do extraordinary things to try to stabilize the economy, and people were really confused and saying, wait, what is this, what's going on, why are you doing this? It's very unsettling. But we had not built up the trust with the American people. So I think everyone across the Federal Reserve System, starting with, then Chairman Bernanke, then Chair Janet Yellen, and now our Chairman Jay Powell, and many of the presidents are doing everything we can to try to engage with the public in a very open, honest way, to share with you what we're doing, to try to build that trust so that you get to know us, you see what we're doing, and then heaven forbid in the future, if something goes south in the economy and we have to do extraordinary things again, hopefully at that point we will have earned the trust of the public so that you can support us when we have to do some of these things in the future.
First of all, thank you for taking time today to speak with us. Appreciate it.
My pleasure, absolutely.
So it's not my intention to derail the entire conversation, but I was wondering if you could speak to the Fed's position on crypto.
Sure. The Fed does not officially have an official position on crypto. My personal views on crypto, I'll speak to those, are evolving. I was more optimistic about crypto a few years ago than I am today. The big problem with crypto is the barrier to entry of a new type of coin is basically zero. So if you go back in American history, there was a time when every state had its own currency, different banks had their own currency, and it was inflation by chaos. You didn't know who to trust. Is Larry's currency better than my currency, better than your currency? Who knows what? Then eventually the US government came in and said, no, there's going to be one currency, backed by the United States of America, and ultimately it's now controlled by the Federal Reserve. And it's that scarcity value, that monopoly value of one currency for the country is in part what gives it its power and people's confidence in it. Well, the problem with crypto is you've got Bitcoin and you've got thousands of other types of coins, most of which, by the way, now are dead coins. They're dead and broken. They raise money from unsuspecting people, and a year later, they're worthless. And so the problem is there's no barrier to entry for you creating a new coin. You may say, well, no, there's only so many Bitcoin that can ever be created. But if I create a coin and I call it Neil Coin, and it looks exactly like Bitcoin, and it has every feature of Bitcoin, what's the difference between Neil Coin and Bitcoin? There's no difference. So the whole sector, in my view, has become a farce of all of these garbage coins that have been created, leading to complete confusion and chaos. So, 5 years from now or 20 years from now, could something useful come of it? It's entirely possible. I'm not ruling it out. But right now, it's basically nonsense. And there needs to be a fundamental shakeout. But I don't know what's going to create the barrier from all these other coins just flooding in the market, adding to more confusion.
Hi, my name's Jason. I'm the president of the investment club here. Also, our first meeting is tomorrow at 6, shameless plug. I actually disagree that the economy is not at maximum employment. So I think it's very regional. If you take the two major economic hubs of the United States, San Francisco and New York, like there's a lot of inflation and there's a lot of stealing of employees like you would assume in a maximum employment economy. But however, if you take the rural areas, it's much less different. So when we measure inflation or when we measure employment, we take the national average, which is actually false because if you have inflation of like 3%, like it's like 11% over in San Francisco. So then, the next part is we set interest rates based on the inflation of the national average rather than regional, which is actually dramatically like not good for like city centers where they're growing really fast and inflation is almost uncontrollable in certain areas. So how do you respond to that statement?
There are definitely, you're right, there are absolutely regional variations around the economy, and Bozeman is different than other cities in Montana, right? The growth rate here is different, the job market is different, so that's absolutely right. But we're one country, and we don't, there's a free flow of labor across our country, basically a free flow of capital across our country. We have one currency for the country, and so we have to set interest rates for the country as a whole, and that one currency is for the country as a whole. So let's say San Francisco, if you were to have a currency just for San Francisco, let's say maybe you would have higher interest rates just in San Francisco. Well, if San Francisco overheats, it incentivizes companies to move their workers to Bozeman and to move to other pockets, or Minneapolis, or other pockets of the country, or Texas. And that's how things even out around the country, and things end up getting redistributed. So you're right, there are regional pockets, but I don't think we should be setting interest rates for San Francisco. That would not be appropriate for Montana. We have to set interest rates for the country as a whole, and that's why we look at national statistics.
I think that's a good segue to talk a little bit about immigration.
Sure.
And just why that's important to the Fed and where your stance is on the immigration issue.
Sure. So, I travel around our region a lot, and a lot of our rural communities are losing population, right? First of all, as a country, we're simply having fewer kids than we had in the past. It tends to happen in all advanced economies. As societies are getting wealthier, fertility rates are going down. Now, we know one of the sources of economic growth is simply population growth, right? You've got more consumers to buy things, and you have more workers to produce things. So as a country, as we are having fewer and fewer kids, naturally you would think our growth rate is going to decline, and it is simply based on demographics. So I always say to communities, we have three choices, and I'm not offering a moral judgment. Each of you can make your own moral determination about what I'm about to tell you. I'm just laying out the math. The math is simple. You have three choices. Number one, you can accept slower growth. Number two, and people usually laugh when I say this, we can try to subsidize fertility, which is we can give tax credits and free childcare to try to encourage families to have more kids. By the way, it takes about 18 years to grow a new worker, okay? Or number three, you can embrace immigration. And that's it. That's the math. And so we as a country have to decide which of those we want to do. Now, personally, I'm in favor of economic growth. So I wouldn't go for number one. Now, Japan has been struggling with this even more than we are because their population is aging dramatically. But they don't have a culture that embraces immigration. So they've had to go for subsidization to try to encourage Japanese families to have more kids. But boy, is it hard, and boy, is it expensive. We as a country have done a better job than basically anybody else in the world with immigration. We're not perfect, but we've done a better job than anybody else in the world. So to me, personally, I think we'd be crazy not to use immigration as an economic engine to help power our economy. And there are pockets of our region that are growing because they've embraced immigration. So I was in southern Minnesota recently, in Worthington. Most of the rural communities in Minnesota are depopulating. Worthington is growing because they've embraced immigration, which is immigrants are working in their meat processing plants, and the whole town is flourishing. I mean, it's really remarkable to see the growth that they've experienced. But ultimately, these are choices that we have to make. So I come at it from an economic growth perspective.
Hi, my name is Phil Russell. I'm with the Chemical and Biological Engineering Department here. Thank you very much for your time. I have a question, a couple parts, quantitative easing. So as a chemical engineer, if you could explain a little bit about how it works, who's selling what to whom,
sure.
That would be great. But my question is, my financial advisor says that quantitative easing, this is kind of a counter view, is actually bad for the economy. He says it provides a disincentive for banks to lend. And so he is trying to train all of us to cheer every time a quantitative easing program comes off and says it'll actually be better for the economy. So I'd like to have your opinion on that as
Sure.
in addition to explaining what it is.
Okay. Well, offer my apologies in advance. So first thing, what is it? The way the Federal Reserve typically stimulates the economy is we would lower short-term interest rates. Now, overnight interest rates, actually. Now, you don't care, and I don't actually care what the overnight interest rate is. I care what the interest rate's going to be on my mortgage. So over the next 5 years or the next 10 years. So really what affects economic activity is what happens to long-term interest rates. So when we move short-term interest rates down, long-term interest rates, which is like a compound short-term interest rate, moves down a little bit too. Once we've moved short-term interest rates to zero, which the Federal Reserve did in the Great Recession, the question was, is the Fed out of ammunition? The answer was no. Then they went to quantitative easing by buying long-term treasury bonds. If you buy a bunch of long-term treasury bonds, you raise the price of those treasury bonds, which lowers the yield, and that directly lowers long-term interest rates. And that's what quantitative easing is. So the Fed was, quote unquote, ballooning its balance sheet by buying all these long-term treasury bonds out of the market, putting it onto our balance sheet, and putting more dollars in the market, driving down long-term interest rates. So it's a way of stimulating the economy once short-term interest rates are already at zero. Now, the notion that quantitative easing is actually bad for the economy, I mean, there are people who come up with all sorts of goofy theories that, you know, it's hard to refute because I don't know what to do with it. I mean, either if you're going to take out a loan, are you more likely to take out a loan if interest rates are lower or higher? Lower. So when your financial advisor says quantitative easing inhibits investment, ask him if he would rather take out a loan at a lower interest rate or a higher interest rate. That's the fundamental concept behind quantitative easing. Hi.
How's it going? I also feel like I'm kind of switching gears a little bit.
It's okay.
But, I was wondering what your key takeaways were, or your perspective was of the fraudulent account creations at Wells and/or subsequent Regulation R changes to referral incentivizing, and then if you could just elucidate how someone in your position takes that perspective to enact legislative change.
Well, so the Wells Fargo situation, I'll be candid. So Minneapolis Fed does not regulate Wells Fargo, and if we did, I couldn't talk about it. So all I know about is what I've read in the press. So I know what you've read, and I'm shocked as you are that there was this widespread program that incentivized people, tellers across the country to open false accounts or fake accounts, et cetera. And it seems like the regulators are now taking it very seriously and trying to make sure that they're doing the right thing going forward. So, is that possible that could happen in another bank? Sure, it's possible. And I think we all need to be on guard looking out for bad incentives and bad behavior, and we need to make sure banks are doing the right thing for their customers. In terms of enacting legislative change, I mean, it's very, very hard. So I've been at the Minneapolis Fed. Larry started by asking about too big to fail. So we came out with a new plan to quote unquote solve the too big to fail issue. And I've been talking to every member of Congress I can, Republican, Democrat, or from around our region, from around the country, House and Senate, talking about the too big to fail issue, and here are the tools that we need to enact to actually make change. Most people I meet with on both sides of the aisle say, yes, we get it. The biggest banks are still too big to fail. We need to do something about it. This plan seems reasonable. But I'll tell you one thing I've learned about politics. Just because everybody agrees with something doesn't mean something's necessarily going to happen. So I don't know. I mean, at the end of the day, our elected leaders represent all of you and need to take their guidance from their constituents. You have a follow-up. Well, do we regulate private equity purchases? The Federal Reserve does regulate if somebody's going to become a bank holding company by buying up a bank. The Federal Reserve does have to take a supervisory role in that. I don't know about the specific example that you're talking about, but that is something that gets a lot of scrutiny. But the biggest concerns that I have are not small banks. I mean, here's one of the problems that happened with the Dodd-Frank legislation after the crisis is it was too broad a brush. And little community banks were not risky for the U.S. economy. I mean, I don't want a little bank to fail, but even if a little bank fails, it's not going to bring down the U.S. economy. And so we need to recognize in a market economy there will be some failures. The difference with too big to fail is when a giant trillion-dollar bank fails, it can bring down the U.S. economy. And that's why we have to put guardrails around the biggest banks and I believe let the market work for the smaller institutions.
Thanks for the plug for smaller institutions.
I knew that that'd go over well in this audience.
I wanted to follow up on the question of quantitative easing. First, I want to say as a banker, we very much appreciate the Fed's role during the financial crisis and the quantitative easing you've done. But now that the yield curve is so flat and the bias of the FOMC still seems to be toward tightening, could you achieve your tightening objectives by unwinding the Fed's balance sheet without increasing short-term rates?
So in theory, we could. So one of the gentlemen asked a question about the yield curve. This is the shape of interest rates of Treasury, different maturities. You have overnight maturities, 5-year Treasuries, 10-year, 30-year, and there's a curve that makes. And that curve is now flattening, which historically has been a very good predictor of recessions when it inverts. So it's something that I've been worried about and writing about and talking about a lot. So the question is, instead of raising interest rates, which moves up the short end of the curve, could we sell off some of our balance sheet to steepen the long end of the curve? The challenge there is, I think the Federal Reserve under Janet Yellen and Jay Powell have done an outstanding job in communicating how we are going to unwind this giant balance sheet. And for me, just speaking for me, I would be very loath to try to unsettle those expectations. Because, you know, there was a taper tantrum in 2013 where all of a sudden the Fed started doing things that markets weren't expecting, and you saw a pretty dramatic response in markets. That's what I would be most worried about, is triggering some type of a rapid unwind or some kind of unexpected market response. That's why I think we've erred on the side of being over-communicative, very transparent in exactly how this balance sheet is going to unwind. The markets have taken that very comfortably. Personally, I would be nervous about potentially undoing that.
Let me change the question just for a second before we go to the next one, because there's a perspective on the Fed that I want you to talk about a little bit. When I first became involved with the Federal Reserve, one of my first board meetings, I was shocked that one of the topics at our board meetings was early childhood development. Of all the topics that we've talked about today, the economy, inflation, all different kinds of things, why would early childhood development be of interest to the Federal Reserve? They still work on that, but I think one that is interesting that you've done recently is the Center for Indian Country Development. So as the Minneapolis Fed has taken on that initiative, could you talk a little bit about what your outreach is and what you're doing with that?
Sure. So we have a small research center at the Minneapolis Fed. We have a lot of Indian tribes in our region, in our district. Montana, certainly the Dakotas, Minnesota, et cetera. And what's happening in the local economy there matters too. And their challenges are different than challenges in Bozeman. Their needs are different. And so trying to understand how does Indian country fit into the dual mandate of the Federal Reserve, price stability, maximum employment, what can be done to try to get credit. You know, when we go on Indian reservations, one of the challenges, they got a lot of challenges, one of the challenges is how do you get a loan on trust land? And you know, if you have Indian family that they've got jobs and they've got cash flow, but how do you get a loan on the land that's owned by the community rather than owned by this individual family? And so we are doing a lot of work with our legal experts and others to try to come up with solutions, working with the private sector to try to get credit onto Indian country. So these are profoundly challenging problems, but they are an important part of our region, and we represent them too.
I know this was in conjunction with the Treasury, but everything I've read and heard about TARP is that it needed to be done and it needed to be done now. If there had been a little bit longer period of time over which you could have set it up, do you feel that there would have been any drastic changes versus the rollout that did occur?
You know, I've thought a lot about this. What would we have done differently if we could do it again in the crisis? You know, we tried lots of things, and I give my old boss, Hank Paulson, the Treasury Secretary, and then Fed Chairman Ben Bernanke a lot of credit, because when we were facing this economic collapse, they basically said, let's try every idea we possibly can to prevent this collapse and hope that the collective action works. And the good news is the collective action did work, though not every one of our individual ideas worked. So with the benefit of hindsight, I mean, I'd probably do some of the things that worked more than some of the things that ended up not working. But I think we, through a little bit of luck and through a lot of hard work and a lot of sweat, we basically got the big stuff right. The thing that we screwed up the most was the communication of what we were doing and why. And the challenge is this. You have the Treasury Secretary and the Fed Chairman who want to tell the American people just how terrified they are, what's at stake if the economy collapses, to generate political support. But you have the Treasury Secretary and the Fed Chairman trying to give confidence to the markets at the same time. So those are two different messages, and they've got one microphone. So you end up with a very muddled message of a little bit of confidence and a little bit of fear. And that did not help us. But that's kind of where we ended up. So I haven't looked back and said we should have fundamentally changed this program or that program, but I do really wish we could have done a much better job on the communications. But that's why my colleagues and I are working so hard to try to build this trust now, so that heaven forbid we have another, when we have another economic downturn, hopefully not a crisis, that we're better prepared for it.
I teach a community banking course, a commercial banking course, and yesterday our topic was monetary policy and banks' role in monetary policy. And we were looking at two Federal Reserve graphs that were very different. One is a dramatic increase in the money supply since the financial crisis, and the other is a mirror image graph of a decline in velocity. And so we had a pretty good discussion about what the reasons for the decline in velocity might be. And I said, well, let's just ask President Kashkari at the event today. So is velocity something that you look at, and is the fact that it's still at all-time lows, at least as far back as our graph went, is that, can you draw any conclusions about that in terms of the health of the economy?
Well, I think it goes back to, we don't look at it as much as they do historically. So I go back and I read old FOMC transcripts, and I read economic history books of prior economic cycles and whatnot, and it was a much more actively discussed topic back then than it is now. Now what I'm personally more focused on is the notion of a neutral real interest rate. What represents neutral? So, you know, the notion of, is the Federal Reserve right now stimulating the economy, or are we tapping the brakes? Well, where's the interest rate, and what represents the neutral position? Well, it turns out, we believe, that that neutral rate has changed over time and it has actually been declining. So to me, the more fundamental question that we're wrestling with is, where is the neutral interest rate today? We think it's very low relative to where it was 30 years ago. Why are things like productivity growth so low? And it's not just in the US, it's in advanced economies around the world. Why is wage growth so low? These are the types of questions that we're more focused on. To me, the productivity growth question is really fundamental, is are there great places to invest in the US economy today as there were 15 or 20 years ago? If there was, you know, imagine there was another oil boom, but much bigger and huge demand for capital, you would expect to see neutral interest rates to be much higher because there'd be huge destinations for capital to invest in very productive places. And I would expect to see the velocity of money would probably be higher too. So these things are related. So to me, the question that we're wrestling with the most is, why is productivity growth so low, which then leads to wage growth and just overall lower economic dynamism. And I think one manifestation of that are the statistics that you're looking at. But we don't have great answers for it, unfortunately.
Hello, my name's Chris Wright. I teach in the economics program, and again, like everyone said, thank you for being here. Two-part question. As a member of the Open Market Committee, could you just elaborate a bit on the process of, the Fed's role in, purchasing securities from treasuries to help finance the deficit? I don't know if I'm correct. I'm thinking we're maybe coming in around $1 trillion annual deficit this current, I don't know if it's FY18 or 19. So it was just that, just if you could kind of enlighten us about what share of that $1 trillion the Fed will help finance, so to speak. And then the second part is any reason China might alter its trend or purchase of Treasury securities?
So when the Fed was in full-blown quantitative easing mode, I don't remember the percentage, but the Fed was in fact buying a lot of Treasuries issuance every year. Now, though, our balance sheet has actually begun to decline. So our holdings of Treasuries are actually declining, so they're having to find buyers elsewhere in the markets. And if I'm not mistaken, again, I need to go back and check the data, I don't think foreign buyers are buying as much as they did, say, 3 or 4 years ago, which means that domestic buyers are making up the share. The big surprise for me, we had the big tax cut that was passed at the end of last year, beginning of this year, big increase in spending, and the Fed is now shrinking our balance sheet rather than expanding our balance sheet, and yet the 10-year Treasury is still only around 285 or so, which is, to me, I would have expected the yield on the 10-year Treasury to climb a lot more given the supply and demand dynamics that we just described. So that, to me, says that there are buyers in the U.S. and around the world who are finding this an attractive investment, and they're making their own decisions at this market interest rate. It's not the Fed that's setting the rate, especially because our balance sheet is now shrinking.
Hi, I'm Amy Highfield, and I live in Red Lodge, Montana. It's about 2,500 people just south of Billings. I work for a foundation that funds in both Indian country and in early childhood, so I really appreciate the Fed and Minneapolis's work in both of those areas. And I just heard Larry mention early childhood as one of the topics that he originally went to a meeting on, and so that's the thing I'd like to focus on here. What we're finding within our foundation and the foundations we work with across Montana, that access to quality child care is really at a crisis level. Infant care specifically is something that you can't find in a lot of communities, especially in mine. And so it's actually starting to impact what kind of jobs people can get and whether they're fully employed. Maybe they're working part-time or trying to juggle something within their family. So I'm wondering what your thoughts are on how we can increase access to quality childcare, especially at those young ages.
Well, it's a tough question, and I get that. I mean, this topic comes up a lot, as you know. Almost anywhere I go in our region, this is a topic, as is affordable housing. This, to me, feels, well, there's two components to it. One component, I would say, is as wage growth picks up, one of the surprises we've seen is that a lot more people have come off the sidelines to take jobs. We had a meeting, I had a meeting earlier today where we were talking about child care. We were also talking about elder care. So my father passed away a year ago. My mom was taking care of him. As our society ages, there's bigger and bigger and bigger needs for care for our aging population. So there's a lot of job growth in this, and yet wages there are still incredibly low. And so it's just, I'm wrestling with this notion of, we all care about our kids, or we care about our parents. Why are these wages so low? And that's something I don't have an answer for yet. I mean, why don't we pay our caregivers more than we pay our lawnmowers? And I don't know the answer to that question. What structurally is causing this disconnect between there's huge demand for these services and yet wages are still so low? So part of it, I think, is wages need to go up to attract more people into the field. And then part of it is pure fiscal policy, where as a country we have to decide if this is a priority and is there a role for government to help meet the needs of the communities. But I wish I had a better answer for you than that, but it's a topic that comes up a lot.
Great.
As a Fed governor, how do you factor in the decrease in labor mobility? You know, here in the Northern Rockies, we have a massive construction labor shortage that in prior periods would be filled by the blackjack dealer in Las Vegas or something like that to become a framer. How are you really factoring in the decrease in mobility?
Yeah, so it's funny, I had this discussion this morning with these tech leaders that I met with, and I said, they're talking about the housing shortage in Bozeman. And I said, that's interesting, because when I went outside of my hotel room this morning, I looked around, there's a whole lot of land around here. So why is there a shortage? And somebody said, well, you can't get people to build them. And then other people said, oh, that's not true. I built a home in 8 months, they built a home, and they've got thousands of homes going up over there. I don't believe that there's been I believe there's been a decline in movement, which is different than a decline in mobility. One of the lessons from the oil boom in 2014 is that when oil prices shot up and wages shot up in North Dakota, people flocked to North Dakota from all over the country. People are willing to move for excellent opportunities. They're not willing to move for $1 an hour more. And so I don't believe that there's a labor shortage here. I believe that if you pay more, you will attract workers from around the country to build homes. Because why would people be less willing to move now than before? Why wouldn't the blackjack dealer in Las Vegas want to come build a home here? Well, if you're not paying much better wages than he or she's able to make in Las Vegas, they're not going to move. And so, you know, the economics profession is hung up on this decline in mobility, and I think there's a difference between a decline in mobility and a decline in movement. One last anecdote. As soon as I joined the Minneapolis Fed, I went to the Iron Range of northern Minnesota, which at the time had a bunch of shut down iron ore mines. And I met a bunch of laid off iron ore workers. And I said, you know, these are skilled tradesmen. And I said, 2 hours south of here are really good jobs in the Twin Cities where you guys are really well qualified for. And they said, oh, no. We want to work here. Our families are here. We want to stay here. They had options. And they're saying, no, we want to stay put. So if people are choosing not to move, I'm not sure that that is a public policy problem. And that's why I differentiate between mobility and movement. But I appreciate your question.
So we're getting low on time. Do we have one more question? And then we've got, yeah, that'd be great. One more question.
Hi, my name is Madeline. I'm a chemical engineering student here. I want to backtrack a bit when you were talking about immigration. The economy here and around the world, I feel is changing dramatically in that education is more important now than ever before. And I was wondering if you think that, one, if we should, and two, if we even have the luxury of incentivizing immigrants of certain education levels to come here.
Personally, if it were up to me, I think so. I think an immigration system that is designed to meet the needs of the economy makes eminent sense. So if there are skills that are in demand in the economy, and we can tailor the immigration program to fit that, and it may not just be the high-tech workers, it might also be people to work on farms, et cetera, but matching the immigration program to the needs of the economy. I think Canada has a skills-based immigration system. There are other countries that do it. This makes intuitive sense to me. So to me, yes, you know, but ultimately the public has to decide.
So I've got two more quick questions for you, Neil, before we wrap up. One of them is, several years ago we were together doing this, and one of the questions I think that got an incredible response from people afterwards was, with the students in the crowd, what advice would you give students that are here today, especially mechanical engineering degree?
Yeah. I don't remember what I said. I wish I knew the answer because people appear to have liked it. I'll tell you, I have never planned out my career. I have pursued things that I found very intellectually stimulating and challenging. And I found that my only objective was to just crush my job. Just do a fantastic job in whatever I'm doing. My managers would recognize that, hopefully, and then they give me more responsibility. I had a professor who at a young age told me, or a teacher said, you know, you ever play pinball? The students here probably have never played pinball, but if you played pinball, the reward for a great game of pinball is you get another ball. So if you do a great job in your job, your manager will give you more responsibility, and that will open more doors. So people have asked me, how much time do you spend networking? 0. Zero. I've always said to people, just crush your job. People will recognize you're doing a great job. You'll be a go-to resource for your managers, and you'll get more responsibility. And if you get more responsibility, it's just going to open more and more doors. And so that's all I've done. I've never planned anything out. Life is long. You can do different things. I was an aerospace engineer at the start, went back to business school, became an investment banker, went to government, went back to the private sector, and now I'm at the Fed, ran for governor along the way. So you can do lots of different things. But my only advice is just pour yourself into what you're doing, and it'll lead to good things.
And the final question, I just read on the way, Neil grew up in Akron, Ohio, so he is a Cleveland Browns fan. And I just read that Tyrod Taylor's starting rather than Baker Mayfield. So is that a good thing or is that a bad thing?
So I've been a Browns fan for long enough to know not to get excited in the preseason.
Well, thank you, Neil.
Thank you very much for having me.
Appreciate your time today.
Appreciate it.
Thank you.
Thank you. This is great.
Yeah, thanks.